Welcome to Smart Project Concepts. We finally made it. What I call Smart Project Concepts is this is a university grade education in Forex. What you're going to see, there's going to be a bunch of webinars, a bunch of videos down below. All these videos, they are recorded in a virtual class setting. It's like I'm here in the classroom and you're on the other end watching how we present things, present simple concepts on the whiteboard in a virtual class setting. Now, I know a lot of you members are older members of Market Fluidity and you're just getting into Smart Project Concepts watching this. There's nothing new. Some concepts are newer, but some concepts are even more broken down for a better understanding. For people who are new, I welcome you all to the best education in Forex when it comes towards simplicity. As new traders, there are a couple of things that happen, right? Psychologically, things go wrong. Mentally, things go wrong. You go into over trading, over risking. But once you truly understand what price is really doing, where market is really moving, how candles are really printing, all these things go away, which is why there are a couple things that we really focus on a lot in Market Fluidity and now coming into Smart Project Concepts. All these things, they go hand in hand, and technically, if you really truly understand how price is moving, why is it moving, when there's volume, when there's not volume, psychologically, your whole perception about trading gets better. So, take it slow. There's a lot of information. There's a lot of knowledge in this section and the Market Fluidity section. So what I'm going to say is if you are new, if you've maybe been in the Forex market for about a month or 2 months, I would highly recommend following these concepts slowly and gradually, building a trading plan, refining your trading plan, and you're going to see a light at the end. This has happened to a lot of people. This is still happening to a lot of people, and a lot of new people are going to see that light, are going to see that light of profitability. That's what I call it, right? It's going to happen. So if you think it's not happening for you now, you just got to dial down on your risk, on your trading plan, on the time that you're going to trade, how you're going to focus on all that stuff. So it's game time. Good luck and take care. Give their trades a second chance. So there are different scenarios that we discussed over here. So what we're going to do now is we will go over how to add risk back to your trade. So we're going to go over that. How to add risk back to your trades. Let's take a look at this right here. Now, this basically, fits in perfectly with giving your trade a second chance. So we're going to talk about that, how to add risk back. Now, whenever we're talking about how to add risk back, it's basically after we've basically managed risk, and when price starts to go back in our favor, that's when we're saying that, okay, we're going to add risk back to the trade now. So let's take a look at this. All right, so in this case, we're going to talk about, so we're going to go over some, like a bearish trend. Let's say we have a bearish trend, price is coming down, you have a bearish candle, and then over here as well, you have a bearish candle coming down. We have another bearish candle, we move down, another bearish candle, move down. And then we have a bullish candle forming, we start to go up. We've created let's say a hypothetical support. We have another bullish candle that goes up, and that's basically it, right? And then we have a bearish candle forming. Boom, resistance formed, trend is down, you're anticipating price to go down. This is, let's say, a 40 pip range, and you're anticipating price to continue pushing down. Now, all of these scenarios, they do happen when price is trending, right? So in this case, price is trending bearish, and this is what we're going to go over. So let's say you take a sell, and instead of pushing down, price starts to go up. Now, the most important thing here is for you to really understand how managing risk works, right? And that's what we've explained in the risk management section, the third one, and also in the risk management 3.0 in Market Fluidity. So you have to go over that first, okay? You have to go over that first. Now, for example, let's say we're looking at the 30-minute time frame, right? We're looking at the 30-minute time frame, and let's say all the 15-minute candles are also bearish. So let's say this 30-minute candle consists of two 15-minute candles, which are basically, like this. You got two 15-minute candles that are basically like this. You take a sell at this point. You've taken a sell, and price wicks up. When price is wicking up, and in this on 15-minute, let's say price is wicking up and moving up, once it starts to break the high of the previous 15-minute candle, you're like, oh, okay, wait a minute. We're breaking the high. Maybe at this point, if we, now, two scenarios, right? One, if we close bullish, I have to manage risk. Or if it breaks the high, I have to manage risk. So you're managing risk. You're closing 50%, right? You close 50% risk right there. Let's say you had a one lot. You're closing 0.5. So now you have 0.5 left open. You have 0.5 left open. You're like, okay, you know what? I don't know. I don't understand whether the price is going to continue to push down. It's going to push up. So either way, you managed risk and you closed 50%. Once you've closed 50%, now you're waiting to see how price is really going to move, right? So let me remove these lines over here because we're going to be using this as well, right? So let's say now the 30-minute candle, it starts to close bearish, and what it looks like over here is that the 15-minute candle, it starts to push on, moving down. Now we've closed bearish here on the 15-minute, and as you can see now, we've created a minor support on the 15-minute, okay? We've created a minor support on the 15-minute, and also the 30-minute candle is moving down here a little bit too. So when we're moving down in the scenario, now you can look around and say, okay, hey, wait a minute. I still have, let's say, a 0.5 lot running, and if the next 15-minute candle breaks the low of the previous one, maybe I can add the risk that I closed. So in this case here, you can add your 0.5 lot back, you know, and your stop is either going to be, it can be above the 15-minute candle, or like, you know, it can be above the current 15-minute candle that's just forming and breaking below the low. Now, there are a lot of things that can happen here, right? This 15-minute candle, you need to have volume to push price down. And this 15-minute candle can just move down without making a top wick in the first minute, first 5 minutes, 3 minutes, 4 minutes. So that's all on your intuition. That's all on your judgment, how you're going to perceive that. But this right here, we're talking about the fact that once we've made a top wick and we've broken the low, that's the perfect scenario to add risk back to your position. As we start to break the low, you can add position back. You're like, okay, you know what? I'm going to add it back. And on 30 minutes, it looks like price starts to go down. Okay? But the most important thing is that you are managing risk. You're actively managing risk. And once price starts to form in your favor, you're adding that risk back. So that's how it works. And there are also various variations to this. Number one variation is that if, let's say, for example, let's say the 15-minute candle broke above the previous high, and the new 15-minute candle, when it forms, it just starts to drop down. You know, once it starts to drop down on the 30-minute, it kind of looks like this. Okay? When this happens, there's basically no way for you to add risk back. If you look at this, right? Because the 15-minute candle, you know, this broke above the high, you manage risk. Next 15-minute candle broke below the low, and it moved so quickly, you're like, oh man, I couldn't manage risk, so I took the trade, whatever I could take. You know, that's why sometimes you can see if you're going to have a one lot and price moves, let's say 100 pips, and you've managed risk here, you, instead of making $100, you make like 50 bucks because you let the 0.5 run till, you know, 10 pips or whatever. But some people are more advanced. Some people are more, you know, experienced. So what they're going to do is they're going to say, okay, you know what? If the 15-minute candle is breaking below this low, and 15-minute candle breaking below this low also means that the 30-minute is breaking below its own low as it starts to go down. That means with volume, there's a higher probability we can continue to push down, and that's where they can probably take an impulse entry to say that, okay, we wicked up, I managed my risk, now we're breaking below this minor support, impulse entry would make sense, so I can add risk back to this trade for price to continue pushing down. Make sense? So you have to re-watch this again. You have to go over this. You have to look at examples. The best thing to do is to look at all the losses you've had in the past, all the losses, and look at those trades and then really ask yourself that, okay, if I took a loss in this scenario, where could I have given my trade a second chance? What could I have done differently so I could have given my trade a second chance? Or there are also multiple scenarios where you managed risk and price still went in your favor. Now, sometimes people over-manage risk, right? Over-managing risk is that you're going to basically close 50% right here, and then next time it goes up, you're going to close another 50%, and before you know it, you only have like 10% running, and 10% that runs, that profit sometimes isn't enough to cover the loss you had closing in negative, okay? So over-managing risk, don't do that. If you're going to over-manage risk, do it only twice. Close 50% once, then close 50% twice. That's it. Don't close more than 2 times. Because if price is going to go in your favor, it's going to go in your favor after that one time you manage risk. If it's going to go in your favor. If you manage risk the second time and it still doesn't go in your favor, just close the whole position. There's no need for that. Because if price then goes in your favor later on, you can give your trade a second chance. Make sense? Right? It's all logic. So, go over this virtual class right here. Go over these classes. There are different scenarios that happen. And also remember, adding risk back to the trade and giving your trade a second chance. They go hand in hand. They are very, very similar. They're very, very similar ideas. Giving your trade a second chance and adding risk back to the trade. They are very similar ideas, and you have to wait for candles to print exactly how you want to see them printed. Now, for example, some things can also happen like this. Let's take a look at this right here together. Sometimes what can happen is that candle is closing bearish, and you're like, okay, candle closing bearish, I'm going to take a sell over here. You take a sell here, and what happens is that next candle, it breaks above the high of the previous candle, right? You get stopped out, and then the candle forms like this, a weak bullish candle. A candle forms like this after you get stopped out. After you got stopped out, and we're still in a bearish trend, and we're still closing below this resistance. Remember, this is a resistance, right? If we're closing below this area, now you know what's the higher probability. The higher probability is if the next candle wicks up and it breaks below the low of this candle, we all know what's going to happen. There's a higher probability with volume we can continue to push down. And that's where you can give your trade a second chance as well. Right? Impulse entry. Most of the time, impulse entries are great to give your trade a second chance, adding risk back to the trade, and so on and so forth. Okay, but the main thing is you have to wait for candles to print exactly how you want them to print. That's very, very important, because you have to see the exact scenario and then you have to execute on this. Because remember, guys, you're trading with money, and this is real money. You can't play around with your money. You have to wait for candles to print exactly how you want them to print. Sometimes, we can look at the candle and say, I have a feeling it's going to move a certain way. Or I have a feeling it can go in a certain direction, so let me just take that trade. Low risk trade, but let me take that trade. But once that trade doesn't work out, your ego's hurt, your confidence is hurt, and things basically go downhill psychologically from that point. So you have to always wait for candles to print exactly how you want them to print. All right, again, remember, giving a trade a second chance and adding risk back to the trade, they go hand in hand. They work together, okay? Whenever you take a loss or whenever you manage risk and you're like, okay, you know what? I've managed risk. Now I'm ready to, accept the risk that I've taken in the beginning, and the price doesn't stop you out and starts to go in your favor. You're looking at different scenarios to see that, okay, does this make sense where I can give my trade a second chance? Because remember, it has to make sense, right? Whenever you're giving a trade a second chance, or whenever you're adding risk back to the trade or a potential move, it needs to make sense from a technical perspective. Also from market structure, it has to form in a way that you recognize that it does work. Now, again, as I mentioned, it does take time. It's not going to happen overnight. You're not going to get really good at it maybe in the next week. Man, I'm not even perfect at it. I'm still sometimes, when price goes in my favor, I'm still kind of hesitant to maybe give it a second chance, but I still do. Most times when I still do, it does go in my favor. Sometimes it doesn't. That's the probability of trading. So you have to give it a chance. You have to just watch how price moves. Whenever you take a loss, step back. relax. If you managed risk, be happy about it, because a managed risk trade is a winning trade because you lost less than what you planned on losing. Now, go over these things, go over the section again, and look at your losses, look at the trades where you closed early. Now, sometimes guys ask, hey man, listen, like I closed my trade early, what could I have done? And the answer is very, very simple. Whenever you think you should be closing a trade early, close, let's say 90%, or close like 50%, whatever, right? We've discussed that as well. So take care everyone, go over this section, and always go over your losses, and you're gonna be surprised how many things you can find in them. Take care.